All right, good morning and welcome to RPC's presentation on the new tax law and what advisors should know. This is Josh Kegley with Retirement Plan Consultants, and I'm proud to introduce Jeremy Palm and Dave Brower. We have 60 minutes on the calendar today for the presentation. We expect the running time will probably be about 45 minutes with 15 minutes left at the end for Q&A. You have all been muted on today's call. However, if you have any questions during the presentation, please feel free to submit your questions within the chat box. We'll answer those after the webinar is completed. Now let's go ahead and get started. As I mentioned earlier, we have Jeremy Palm and Dave Brower of Lurie presenting today. Dave is a partner of Lurie's Tax Services and has a wide variety of experience from tax needs for publicly traded corporations to closely held family businesses. And Jeremy is the manager of Lurie's Retirement Plan Consulting Division, specializing in design of defined benefit plans, both traditional and cash balance. RPC works closely with Lurie on many complex defined benefit designs and implementation. And Lurie has been a longtime great partner of RPC's, and I'm sure some of you have had some experience working with Jeremy on some cash balance plans in the last few years. With that, I'll go ahead and turn it over to Dave and Jeremy. Thank you.
Thank you, Josh. We're going to start kind of with an overview of the new tax bill, and we still call it the new tax bill, even though it was enacted back in December. And we have lots of slides here, lots of information to talk about, but we're going to just kind of highlight some of the portions of the tax bill. And then Jeremy's going to dive much more into how those interact with cash balance plans. So as we go, this first slide just shows kind of the harried nature of the enactment of the tax bill. Total of 50 days from the date it was first presented to the public by the House until the day that it was signed by the President. With that in mind, these kind of bills you would normally be expected to take 5 months or so, and they did not quite get everything right as they were doing this. There's lots of guidance that we have asked for and lots of clarification that we have asked for. We've gotten a little bit so far, but hopefully we will get quite a bit more. And we'll point out a couple things as we go through. In general, the business provisions in this tax bill are as permanent as tax law can be. Unfortunately, we normally put permanent in quotation marks because at any time Congress can change the tax laws to whatever they deem appropriate at that time. So these are not set to expire, whereas we get into the individual provisions, those are set to expire. So the big headline piece of the whole thing was the corporate tax rate. Went from the graduated rate that went all the way up to 35% to a flat rate of 21%. So tax cut for many businesses, but a tax increase for those that were under $75,000 of taxable income for corporations. This is just for C Corps, not applicable for S corporations or sole proprietorships or individuals, obviously. And it did lower the personal service corp rate, also now becomes 21% also. So a couple items that the tax bill made much more lenient for people have to do with using the cash method of accounting and also inventories. These are two things that they loosened up and made much easier. And with the inventories, allow businesses to not account for inventories, to expense them as they purchase them. For both of these items, you need to have average gross receipts under $25 million, and that's a 3-year rolling average to determine that. And both of those provisions, regardless of how your entity is structured or what industry you are in, you can take advantage of these new rules. With the inventory piece, one extra requirement is that your financial statements must also treat it the same way as the tax purposes. So you can't use financial statements showing inventory and expense it for tax purposes. It must comply for both sides. These are automatic changes of accounting and can be done with your tax return when you file your 2018 return. A couple items that they also, this is bonus depreciation is the only retroactive provision in the bill. Was scheduled to be 50% for the next few years. The bill went back and made it 100% starting in September 27th of 17 all the way through the end of 2022. The other big piece there is that used property is now eligible to be expensed as bonus depreciation. Just remember, many states do not go along with that, and there may be adjustments for state income tax purposes for bonus depreciation. Real property, this is one of those things where the tax bill didn't quite get it right. Qualified improvement property took the place of the old leasehold improvements, restaurant and retail improvement property. Was supposed to have a 15-year life. That's how they wrote it up and how it was all described, but they missed that in the bill, and so it will require a technical correction to get the 15-year life. So if it isn't corrected, the life of improvement property will now be the same life as the building, which is either 27.5 years for residential property or 39 years for business property. Keeping in the theme of making things a little beneficial at the business side, Section 179 expensing doubled, went from $500,000 to $1 million, and the phase-out starts at $2.5 million. Also expanded the definition, allows for a couple items of a building, the roof, HVAC system, and those other few items. Remember, the big difference between 179 and bonus depreciation is that 179 requires that the taxpayer has taxable income, whereas bonus depreciation can drive you into a net operating loss situation. 179 cannot. There's new provisions on limitations of business interest. Again, this is for businesses with more than 25 million of average gross receipts, the same 3-year rolling average. This is a calculation where you look at, for the first few years, you will take the taxable income, add back the interest expense, add back the depreciation, and multiply that number by 30%, and that would be the cap on the amount of interest expense that you're able to deduct in 1 year. After 2021, the add back for depreciation goes away, and so this will be much more restrictive after 2021 than it will be for the next few years. But any amount that gets disallowed goes back into the calculation for the next year. It carries over, it doesn't ever expire, but you do have that limitation that you will have to calculate each year. Net operating losses, if you have a year that you derive a loss, changes the way that you utilize those losses. No longer can you carry a loss back 2 years to get some past taxes, but it never expires, so you can carry that forward indefinitely. And the other piece is it does limit the amount of an NOL that you can use in 1 year to 80% of that current year's taxable income. So going forward with new NOLs, you will always have a little bit of tax due if you have income in that next year. You can't offset 100% of your income. Entertainment expenses, this is another one that's gotten a lot of publicity. This is one that we don't have complete clarification on at this point. We do know that taking a client or a customer golfing or to a theater event or to a sporting event will be not deductible at all any longer. It used to be 50%, it is now 0. And also the meals, for the convenience of the employer, used to be 100% deductible, and we've now limited that to 50%. What we're not sure about is taking a customer out for dinner or lunch. And that is a great debate right now, and we're waiting for clarification to see what the intent was. At this point, until there's clear guidance that says that is entertainment, I would recommend that you continue to take 50% deduction, but know that that's something that the IRS may push back upon. Gain deferral, like-kind exchanges got a little more difficult, but opportunity zones pop up in this new tax bill, and these can be more beneficial than a like-kind exchange, but does limit where you're investing that money. So rules to look at there. Like-kind exchanges can only be done for buildings and land at this point. The pasture deduction, this is one that we're going to talk about. Jeremy will talk about a lot with at the latter part of this presentation. But this is one of the more complicated tax provisions that's out there. And they've kind of broken the whole world of business into two different types of business. So they have qualified trader businesses and specified service businesses. And the good news is they define a qualified trader business as anything that's not a specialized service business. So we just really need to know what the specialized service business is. And those are businesses that derive their income from the practice of law, accounting, actuaries, consulting, athletics, performing arts, investment management, those types of businesses, financial advisors. If you're a specified service business, you will be limited in your ability to get the pasture deduction. Once you determine which type of business you're in, they kind of broke it into two separate thresholds again, whether or not you make more than $314,000. And what they look at is if you're a specified service business and you're under that threshold, well, if you're any type of business and you're under that threshold, good news, you get to take 20% as a deduction against your income. If you're over that threshold, this is where things start to get a little murky. If you're a specified service business and you get over the 415, which is the phase-out range, it's easy to calculate your deduction, but it's not good news. It's zero. Specified service businesses where the individual owner makes more than $415,000 is not eligible for any pass-through deduction. If you're a qualified trader business and you're over the 415, the second rule comes into play, where you have to look at the amount of wages and property that are in the business to determine whether or not you're eligible to get the 20%. If either you're 50% of your W-2 income or wages, or 25% of it plus 2.5% of your property is greater than the 20% calculation, you get the full 20%. If not, you're limited to those other items. So very difficult provision. We've gotten a lot of guidance, a lot of ability to determine what's going to qualify now. Couple other items, and I'm just going to skip through a couple of these. You have the slides and you can see those, and you can always ask questions if you care to know more about these, but many of them. So that pass-through deduction is part of the individual provision, so that will expire after 2025, and all the other individual provisions that are in this slide deck expire after 2025. So in 2026, we go back to the rules that we just used for our 2017 tax returns on the individual side. You can see the rate changes, small rate changes on the individual side, roughly 2 to 3%. Standard deduction went up, but they limited the amount of itemized deductions and they got rid of personal exemptions, so not much of a benefit there for individuals. The big piece that everyone's talking about are state and local taxes have been capped at $10,000, and that is your income tax and your property tax. So anything above that is lost and not eligible for a deduction at any time. Also got rid of the 2% miscellaneous itemized deductions. You can see what those entail. Many people didn't get a benefit because it did have to exceed 2% of your AGI, and you also had to itemize. So mortgage interest, a few rules that changed. Lowered the amount that's generally deductible going forward for new mortgages, but did open it up for a third or fourth home if you've paid off your first two. AMT, they upped this, but this is really not important because the big items that kicked people into AMT were state taxes and miscellaneous itemized deductions, which are minimal at this point. So the only people that you'll see slip into AMT in the next few years should be people that exercise ISOs and don't sell them. So they have a big AMT hit on the exercise of an incentive stock option. So, and now we'll let Jeremy talk about a lot of the other pieces.
Thanks, Dave. Yeah, so we're gonna, a lot of my comments will be focused on cash balance plans, and we'll kind of build into them, look at retirement plans in general, but then focus on cash balance plans, and then look at some examples where the tax reform comes into play, and specifically how that pass-through deduction plays out. So we're going to be looking at what are cash balance plans, who is a good candidate for them, and then how can they be used to improve your client's retirement and tax situations. So at a high level, why, I guess to start, why do business owners even put retirement plans in place? And typically the three main motivations: they want to increase their tax deductible contributions, they want to accelerate their retirement savings, and then maybe there are some employees that they really want to hold on to, and so retaining their employees and attracting new talent to their companies. So this next slide, we're looking at how these deductions increase as you look at the various plans, and the following slide will actually have numbers around these. But as we'll see, the cash balance plan can be used to greatly increase the total amount of tax deductible contributions as compared to a 401k plan alone or a SEP. So here are the numbers, before we look at the cash balance plan limits, and I'm sure many of you are familiar with the limits on this slide. I guess the one thing I'll point out here, I know I ran into a couple cases this year where the client was sponsoring a simple, and they really wanted to put a 401k plan and cash balance plan in place, but bummer, the simple has what's known as an exclusive plan rule. So the simple has to be in place for the full plan year, and you can't have any other plans with it. So for those couple cases, the clients have to wait until 2019 to implement the 401k and cash balance plan combination. So on the far right, though, the 401k limits, if you're less than age 50, you have the ability, provided you have the income, to get to the $55,000 contribution limit. And then if you're 50 and above, $61,000. And I just wanted to point out here, oftentimes I'll run into situations, and I did, last week, where talking to a retirement plan prospect, and the CPA in this case had communicated to the prospect that, look, all you can do, the best you can do is a SEP. And in this particular case, a combination 401k and cash balance plan could have gotten the prospect a lot more in tax deductible contributions. So in this particular case, instead of being limited to $55,000 in a SEP alone, I could increase his retirement plan contributions and deductions to $150,000 a year without doing anything particularly fancy. The other instance where I think the 401k wins out is that if you have a business owner that's not making, maybe their compensation is lower, say they're making $100,000 in W-2, while with a SEP, they're limited to 25% of that $100,000 in W-2, whereas if you use a 401k plan, now they can do the 25% of their $100,000 in W-2, plus they can do for 2018, $18,500 in deferrals, or $24,500 if they're 50 or above. So hopping into cash balance plans, the big opportunity here is that a business owner can accumulate up to $2.8 million in a tax-deferred retirement plan at age 62. And, that $2.8 million is assuming that the plan is in place for at least 10 years. So it's not, you can't go 0 to 2.8 any faster than that. But at the end, when you go to terminate the plan and roll over the assets to a traditional IRA, or at least that's typically what business owners are doing, they can roll over $2.8 million for themselves from the cash balance plan. And sometimes I get the question, where is this $2.8 million? Where is this coming from? Why 2.8? And I just wanted to, there's nothing magical about it. The IRS for 2018, the IRS says that the largest annuity that you can be paid from a defined benefit plan is $220,000 per year. And so then we're just taking that $220,000, we're calculating what's the present value of that $220,000 annuity. And so here, we're just multiplying the $220,000 per year times an annuity factor that uses the mortality table and 5.5% interest rate to arrive at that maximum lump sum of $2.8 million. And this is an amount that, between age 62 and 65, it starts to decrease some, and then after age 65, it starts to go back up. But this is an age 62 amount, and that's where that $2.8 million comes from. So before we were looking at the retirement plan, whether it's simple SEPs, 401k plans, well, now we're adding that cash balance plan column, and we're assuming an age 62 retirement age. I know the table goes all the way to 65, but you can see how these greatly increase as the business owner gets older. And so again, going back one slide to that $2.8 million bucks, when we look at those limits, to get at that $254,000 at age 60, we're just reducing it or discounting it back to their current age to come up with these amounts. And so as you can see, if they're just using a 401k plan alone and they're maxing out, say at $61,000 for a 6-year-old, well, there's a lot of room. If they add a cash balance plan, there's a lot of room for them to increase those retirement savings or increase their contributions and their tax deductions at the same time by adding a cash balance plan to the mix. So just some basics with the cash balance plan. They are a specific type of defined benefit plan, but they look and feel more like a 401k plan. So participants receive statements, and we're going to look at a few slides coming up, where the statements really look and feel more like a 401k plan statement. And so whether it's the business owner or the individual employees, these cash balance plan account balances, it's a little easier to understand. Hey, I have $20,000 in my cash balance plan account versus the traditional defined benefit plan where I'm working towards some monthly annuity benefit at retirement age. And the big advantage with these cash balance plans is that, again, as I've mentioned already, they can make larger contributions to them as compared to a 401k plan alone. So from a participant statement perspective, here I just, at the top, I've shown what a participant statement, just one part of it, what it might look like. And so, I've assumed at the end of 2016 that this participant or business owner has $100,000 in their hypothetical account balance in the plan. And in 2017, or the way the plan was set up, is that the pay credit will be equal to a flat dollar amount of $100,000 per year. And then we also define this, we've defined the interest credit to be 4%. And so I know, based on the pay credit received and the interest credit received, that at the end of 2017, this business owner would have $204,000 in the cash balance plan. And so here the cash balance plan account balances, they grow by two pieces. One is that pay credit, and typically that is a percentage of the pay, or it can be a flat dollar amount, as I've used in this example. And then the second piece that the account balances grow are by the interest credits. And so the plan is guaranteeing that rate of return, and it's independent of the plan's investment return. So the investments might be earning more than that or less than that, but the plan document is defining the interest credit to be, in this case, that flat 4%. So then if we expand on this a little bit, that top chart there, I've taken that participant statement from the previous slide, and I've projected forward, hey, what will this balance be, assuming that no other amendments are made to the plan? What will this hypothetical account balance be equal to at the end of 2019? And so if we walk through this, at the end of 2017, we said that the hypothetical account balance equaled $204,000. Well, in 2018, that business owner is going to receive another $100,000 pay credit. And in 2018, they're going to receive that interest credit. So 4% of the beginning of your balance, that $204,000, or $8,160. And so at the end of 2018, that hypothetical account balance will grow to $312,160. And then the same will be true as we project forward to 2019. The interest credit, again, that $312,160 will grow by another 4%. They'll get that $100,000 pay credit. And so at the end of 2019, we're looking at almost $425,000 for this business owner in the cash balance plan. And the point I want to make here is just making the connection that a cash balance plan is a defined benefit plan. That this $100,000 pay credit and the 4% interest credit, those are things that are defined in the plan document, and it's defining the benefit for each of the participants in the cash balance plan. So you might have noticed, or maybe you've wondered, why hypothetical account balance? Well, all of these, I guess the first bullet there, all of these contributions first they're being made by the employer. So these are not employee monies like employee deferrals in a 401k plan. All of these contributions are being made by the employer into a pooled account. And so we've got that pot of gold in the lower right there, but all of the money, so that one pot is accumulating all of the employer contributions that will be used at the end to pay everyone out. In the prior example, the business owner at the end of 2019 was at almost $425,000 in his or her hypothetical account balance. Well, that one pot will be used to pay out that business owner. It will also be used to pay out any other participant and their hypothetical account balances. But each person's or each participant has a share of that one pot that all of the money is going into. The plan assets, so the employer does take on the investment risk, in terms of how the contributions, how the plan assets will be invested for the cash balance plan. And the example that I've used so far is just that flat 4% interest crediting rate, but that essentially becomes the target. So between the employer and the financial advisor, that becomes your target, what you're trying to earn on the underlying plan assets. That said, at any given time, the plan assets might be worth more than what the total hypothetical account balances are, and vice versa. So it might be less at any given time, it might be more. We're going to be looking at a couple slides that show this difference, where there is a shortfall and where there is an excess. And one of the things that we do as a part of the annual administration, we prepare an actuarial valuation report that will contain a minimum required contribution that the employer needs to make, and then on the other side, the maximum deductible contribution. So when revenue is in a year when revenue is really good, the employer might want to be more on the maximum deductible contribution side of the range, and when the business revenue, maybe it's not as good a year, maybe they're going to be more on the minimum required contribution end of the range. So I mentioned here I've just, one of the questions that comes up quite a bit, if we take a step back and think about a 401k plan, if I'm logging into my 401k account online, any money that I see in there, if I terminated and take the money, what I see online in my account is what I have. Well, compare that to a cash balance plan. As I developed back a couple slides here, we are defining the hypothetical account balance. So I know what that is based on the plan document and the plan's provisions, regardless of what the actual plan assets are worth. And so what I have on the left-hand side there, I've got, let's assume the cash balance plan has 3 participants, and at the end of 2017, each of those 3 participants has $204,000 in the hypothetical account balances for a total of $612,000 at the end of 2017. Now, on the right side, I'm showing $550,000 is actually in the brokerage account or trust, and that's our one pool, our one pot of money that's going to be used to pay the $612,000 in hypothetical account balances. So just to show you this idea, showing a chart where we've got $612,000 in hypothetical account balances versus the $550,000 in actual plan assets. So in this case, we've got a shortfall of $62,000. And so, when we're calculating, this comes into play when we're calculating that minimum required contribution versus maximum deductible contribution range every year. That will come into play. And in this case, if the business owner wanted to fully fund their plan as of the end of the year, if they made a $62,000 contribution, the plan assets would exactly equal the hypothetical account balances. Now in this next example, I flipped it. We've got the same value for the hypothetical account balances, so $612,000. But now at the end of 2017, the plan assets, I've assumed they're worth $660,000. And so if we compare the plan assets to the hypothetical account balances, now you have an excess of $38,000 at the end of 2017. And so I would say in general, most of the cash balance plans that we work with, they tend to be very well funded. The business owner is putting the plan in place to receive the tax deductible contributions associated with the plan. And so, you know, a lot of these plans end up with some excess that they can either apply in future years or will ultimately reduce what they have to contribute in future years. So with that said, moving on to good candidates for cash balance plans. Well, one trigger is, you know, maybe you have a business owner who is maxing out their 401k plan contributions. So they're putting in $61,000, but they're saying to you, hey, we'd really like to do more if we could. But that's a good, you know, a good signal that maybe they should look at adding a cash balance plan to determine if it works for them. Another thing is just companies in general with steady cash flows. Yes, we can work with them if their cash flows aren't steady, but in general, you know, having that more or less predictable revenue year after year, that can be a good thing for cash balance plans. As we saw earlier, as the business owners get older, the amount that they can contribute to the cash balance plans increase pretty dramatically. So again, in general, older owners, it's going to get them more in contributions. And in a tested situation, those older owners will probably help as we're doing the combination plan design for them and calculating how much they have to contribute to their employees in order to get what they want for themselves. That kind of leads into the next one there. Really, owners have to be willing to contribute something, and we determine what that something is. But in general, you know, between 7 to 10% of their employees' pays when you look at the 401k, safe harbor, profit sharing, and cash balance contributions. Typically, that's what we see. And one of the examples later, we'll actually look at where the results fall between that 7 to 10% range. And then the last one there, in terms of the size of cash balance plans or the size of the companies that are putting them in place, you know, a vast majority of them are in place for companies with less than 100 employees, and even more so with less than 25 employees. So here's where we pick up on some of what Dave was saying earlier about the pass-through deduction with tax reform. And, you know, I guess just conceptually, I want to highlight a particular range of business owners that are going to benefit even more from adding a cash balance plan post-tax reform versus pre-tax reform. And so, you know, that they're fairly simplistic examples, but it is just to highlight conceptually what can happen for those that fall within the income thresholds. So as Dave mentioned, I'm not going to get into, you know, specified service trade or business versus qualified trade or business, but we're just going to talk more about these income thresholds and how the numbers play out if business owners put a 401k plan in place or a 401k plan in combination with a cash balance plan, and how these can affect them. So based on these thresholds, here I've assumed a married joint filer, and so I'm kind of breaking them up into 4 different groups. And the bottom group there in the blue are those that are below $315,000 in qualified business income. And then as we step up there in the green, you've got that 100,000. So between 315,000 and 415,000, you know, if they're falling within that range, they're within that phase out range. And then the next step in the purple. There's nothing magical about the next 200,000 that I showed there, but just to say they're above that phase out. And so can we put a retirement plan in place or a combination of retirement plans that will get them below the threshold to get them that additional 20% pass-through deduction? And then finally, hey, we'd all love to be in that category, but you have the extremely high earners where even using a combination of retirement plans won't necessarily get them, or we won't be able to get them below the income thresholds, but they still have a lot of incentive, a lot of motivation to put the retirement plans in place because they're still receiving the dollar for dollar deduction on those retirement plan contributions. So this first example, we have a taxpayer that's under the income threshold. I'm going to use these same assumptions for the next 3-4 slides. So I'm just assuming a sole proprietor that's married, filing a joint return, and their income, that they're an attorney, so they're practicing law, and so that's what their income is from. And so if we walk through the charts here, without the plan, their taxable income we've assumed is $250,000. They did not make any contributions to a 401k plan, and so obviously their qualified business income remains at $250,000. But then that 199 cap 8, that 20% pass-through deduction they'd receive is 20% of the $250,000, or $50,000 in this case, and so their final taxable income without a plan would be $200,000. Now, if they make $55,000 in contributions to a 401k plan or a SEP, now that's going to reduce their taxable income from $250,000 to get that qualified business income down to $195,000. And then on that $195,000, they're still receiving that 20% pass-through deduction, and so their final taxable income in this case would be $156,000. Moving on to the next example, essentially the same situation. So you still have a sole proprietor, married, filing a joint return. They're an attorney. But now, instead of making that $55,000 on all of it on a pre-tax basis, now we're just assuming that $18,500 of it is made in Roth or after-tax deferrals. And so you can see how that plays out. It's not going to reduce their qualified business income as much, so that with the 401k plan in place, their qualified business income is $213,500. And then on that $213,500, they receive the 20% deduction, which brings their final taxable income down to $170,800. So in some cases, you'll have participants or business owners that maybe they'll lean more toward making the Roth deferrals because it won't hurt them as much on the tax side because of that 20% pass-through deduction they're receiving. Okay, so here's where I would say that the big opportunity is. If I go back a couple slides to the groups, how we were breaking down these taxpayers, the next example, they fall into that purple category. So that they're without the retirement plan contribution, their income is going to be above the phase-out level. So, like I said, the same assumptions, sole proprietor, married, filing a joint return. Now we've just upped their taxable income from $250,000 to $450,000. So without a plan, their qualified business income is at $450,000. They're going to receive no pass-through deduction on that full $450,000, and so you've got a final taxable income of $450,000. But if they put a combination of a 401k plan and cash balance plan in place, and we can get them, provided they're old enough, and we get them $150,000 in contributions. Well, now those $150,000 in contributions get them below the $315,000 income threshold. And so in addition to that $150,000 dollar for dollar deduction, well, now that's brought them within the range so that they can also receive the 20% pass-through deduction. And so, you know, as a retirement plan nerd, that is a huge win for this client and for clients in that income range or in this kind of scenario. So that's the big concept that I wanted to drive home here, is that there are some that have even more incentive to put retirement plans in place post-tax reform versus pre-tax reform. And then this final example, you know, here we've just bumped up from $450,000 to $750,000 in taxable income. I guess the only thing that changes here, I've assumed the business owner is a little older. I can get them more in 401k and cash balance plan contributions. But even at that higher $250,000 in contributions, I can't get them below the income threshold. So they miss out on the 199 cap A deduction, but they still have a big incentive to put these plans in place to receive the additional deduction on those retirement plan contributions. And then finally, this is kind of stepping away from the tax reform specifically, but I just wanted to throw in kind of the tested plan scenario. I mentioned earlier how, you know, typically owners are looking at a 7 to 10% of pay contribution to make the 401k plan and cash balance plan combination work. So it really depends on whether the owner's willing to do that. But in this scenario, we've got a couple owners that are both making $250,000, and you have a couple employees, and I've listed their ages there. But this is the kind of thing when we're putting a plan design together, if you've identified a client of yours that you think might really benefit from a 401k plan alone or a 401k plan and cash balance plan combination, then the results depend heavily on how old are the owners and how old are the employees and what are each of the employees making. And so then we can show your client a design where they can make the decision as to, hey, if I'm owner number one, I get to make $186,000 in contributions for myself. If I'm owner number two, I get to make $180,000 in contributions. And what does it cost me? Well, it costs me a 7.1% of pay to my employees in the safe harbor and profit sharing contributions, and then an additional 2.25% cash balance plan contribution. So, you know, in the end, the vast majority of the contributions are going to the owners, and, you know, the employees win as well, because the employees, the dollar amounts are a lot lower, but they're getting almost another 10% of pay in their retirement plans that they wouldn't receive otherwise. So I just wanted to put in a tested plan. This is kind of apart from tax reform specifically, but obviously, you know, tax reform will play into the scenarios that your clients face. So the key takeaways here: post-tax reform, retirement plans continue to be a big opportunity for business owners. And, you know, as I highlighted in example number 2, some business owners have even more incentive to put these retirement plans in place post-tax reform. And obviously, you know, it's important for all of the players, the client's CPA, you, the financial advisor, the TPAs that are involved, and the client to all be involved to understand your individual client situations and how best they can use retirement plans to meet their needs. And I just have some upcoming retirement plan deadlines. We're kind of running up on the last day to set up a safe harbor 401k plan for 2018. And just from a timing perspective, if one of your clients, if you think that they do want to put a cash balance plan in place for 2018, the last date that they have to sign the plan document to establish the plan would be December 31st. And that ends our portion. I guess we'll kick it over back to Josh to see if there are any questions that we can answer.
Thank you, Jeremy, as well as Dave. That was terrific information. Yes, go ahead and type in any questions that you may have. We'll try and get through a couple of them here. Otherwise, your regional director will follow up with you. And hopefully the examples that Jeremy just went over spark some ideas of clients that you have that may be a good fit for a cash balance plan. If so, please give your regional director a call and they can help walk through some scenarios for you. To jump right into the questions here, the first one is a licensed veterinarian a service business?
So with the new regulations that just came out about 2 weeks ago, when they defined who is in the practice of medicine, veterinarians were included in that list. So yes, they will be deemed to be a specialized service business and subject to those limitations.
All right, thanks, Dave. Yep. Jeremy, the next question is probably for you. In your example that had 2.25% cash balance contribution, does this amount change per plan, or is this a set percentage for every plan?
Good question. The quick answer is it changes with every plan. And it, in this specific example, I guess just to go a little farther, in theory, the employees, we could look at including the employees in the cash balance plan, and we could also look at excluding the employees from the cash balance plan. And that's going farther than the question that was asked, but it all comes out. We can look at a lot of different scenarios and how best to meet what they're looking for.
Great, thank you. We might have time for one or two more here. The next question is, does the vesting for cash balance plans have to be the same as the 401k plan and profit sharing?
No, it does not. And the most that you can push it out from a vesting perspective is a 3-year cliff. So no one is vested until they have completed 3 years of service in that scenario. But it does not have to be the same as the 401k plan vesting schedule.
All right, great. And this will be the final question. Thanks everyone for attending the webinar. When determining W-2 wages for the 199A deduction, are owner W-2 wages included?
Owner wages are included. However, that only applies really if you're a S corporation. If you're a partnership, you're supposed to get paid a guaranteed payment, and those are specifically excluded. And if you're a sole practitioner filing a Schedule C, you also don't get a W-2, but your profit is not treated as wages. It does have to be wages paid on a W-2. And so, unfortunately, if you're getting close to the limitations there, you might have to restructure that business to an S Corp in order to get the benefit of wages to the owner.
All right. Thanks, Dave. Thank you again to both Jeremy and Dave for putting on such a terrific presentation. And as I mentioned, if you have any further questions or some clients that you think may be a good fit, please reach out to your regional directors. Thank you, everyone, and have a great day.